Stephen Place on tap, so y'all just hold tight for just a second. I've been friends with this guy for a long time. He's from around here, and he and his wife Ashley and their baby Ari, super family. And he quit he quit being an engineer back in '08, just like y'all, trying to figure out how to be a professional full-time trader from the house, and he did it, and he's been doing it since '08, and now he's takes that information to the streets and shares it. So y'all give him just a second. Okay, 51, that's right, William. Okay, all right, so to stick with our theme of 51, this is so easy, and if you win, you get paid $51, and I'm going to PayPal it to you today. Okay, so here's the question. In what U.S. state is Area 51 located? Brandon is our winner. He said, oh my gosh, Scott, you were right behind him. You almost won both times. A lot of people know it's Nevada. It is the great state of Nevada. Old Area 51. Who'd have thunk it, right? Nevada. Love Nevada. Spend a lot of time out in Vegas working, so I know a little bit about Nevada. But not where Area 51 is, of course. All right, so send me your... Brandon, send me your email address real quick, and I'll pop that $51 your way. Is it just in your mind? That's a good question, right, John? We could talk all day long about the possibilities. All right, let me turn it over to Stephen. He is going to round today's event out, and hopefully you guys will stick with us for one more hour and hear what he has to say. We are recording. Sometimes it doesn't work out, so no promises. No promises on the recording.
All right. Good afternoon and good evening wherever you are in the world. This is Stephen Place from Investing with Options. Jeanette, can you give me a quick confirmation that everyone can hear me?
Check, microphone check. Yeah, I got you.
All right,
I got you loud and clear. Okay.
Backup recording really quick.
That's amazing. And thank you for doing that for me.
So I think there's a questions box, and I'm going to try and magnify that really quick.
There is. Can you hear me, Stephen?
Mike's saying sound good. I can hear you, Jeanette, just fine. And I think that we're going to get started. This is Stephen Place, and today we'll be talking about the exact strategy to earn $500 to $1,000 per week with no added risk, less stress, and more freedom. I'm going to adjust this really quick so I can see all the questions and everything else. Let's minimize that and bring it down a little bit. Okay. Thank you all so much for attending the class. I'm super excited to be sharing a strategy with you today that can give you a sustainable income in the market without needing to pick stocks or stare at screens for 6 hours a day. And that sure would be nice, wouldn't it? Now keep in mind, this training is not for people that want to trade 100 different stocks all at once. I am a big believer that focus brings growth in your own life and your own trading accounts as well. And if you can focus on a simple strategy or two, you'll achieve your goals much faster than you think. Now, before we move on, let's go ahead and put this out there. You and you alone are responsible for your own gains and losses, and that is a beautiful thing, to have complete control over your financial destiny. Financial speculation of any kind has its risks. Whether you're trading futures, forex, options, Bitcoin, tulip bulbs, it doesn't matter. You have the risk of losing a lot of money if you aren't careful. There's the risk that a trade strategy stops working. There's psychological risk in your own personality, and I'm not your broker, and I don't know your exact situation. This is for educational purposes only. With that in mind, let's take a look at some real-world results of this trading strategy. Oh, I guess I got an intro slide really quick. I guess we're going to do a really quick introduction, and then we'll get into the trade system. For those of you that don't know me, my name is Stephen Place. I'm the CEO of Investing with Options. Back in 2008, in the middle of the market crash, I left my well-paying job as an engineer, and I was a terrible employee, I'll tell you what. I left my well-paying job and started to trade my own capital. I'm a student of the School of Hard Knocks, and after successfully and profitably navigating the market crash, I had to pivot to different option trading strategies. I began to write down what I was trading and what I thought of the market, and soon my insights in trading became valuable to a lot of people. I've spoken at the NASDAQ site at Times Square, investor conferences in LA and Las Vegas, and I've been on Fox Business and a couple other shows. I've written for some publications, I've been published, and so on, but my most important asset now is my daughter, who is a beautiful train wreck of a toddler. So let's get started. First, I'm going to show you a magic box. And it's not just any magic box. Okay? It's a magic jack-in-the-box. You see, now my 2-year-old has a bunch of different toys because my in-laws are hoarders and they kept my wife's toys from 30 years ago. So they have this really creepy toy. One of them is a jack-in-the-box. But let's pretend that it's magical. And you could turn the crank and the little music plays and some clown pops up and it tells you to buy a stock. And you start following the clown's predictions and it turns out that within a month, the value of that stock goes up about 10%. Sometimes a little more, sometimes a little less. And so you start putting your money to work and every week you turn the crank and the clown pops up telling you what stock to buy and that stock goes up 10 to 15%. Now tell me, what do you think that magic box would be worth? Is that something you'd be interested in? It probably were worth a lot, right? A magic box that gave you a way to have your position appreciate 10 to 15% consistently and reliably. Well, I'm going to let you in on a little secret. It's possible, and I'm going to show you how. Just keep this in mind. It doesn't really matter what stock we're looking at. As long as you get your 10%, then you're good. Or you don't have to buy a stock, you could short a stock, and as long as the value drops by 10%, then you'd be earning a pretty good income. Now let's take that one step further. Do we even need to look at a stock? Do you even need to own a stock to generate consistent returns? To be quite frank, it doesn't really matter what asset you're looking at, okay? You could be looking at Bitcoin, you could be looking at tulip bulbs or forex or futures or whatever. In fact, with the system I'll show you today, we'll be uncovering a hidden asset class in the market that allows you to generate consistent income in the market. Now, I'm going to ask you a quick question. Can anyone guess what this hidden asset class is? Now, let me know in the Q&A box, and I'll go over a couple. Let me know what you think. While you are answering that question, I'm going to show you some of the results that you can get with this asset class. These are recent trades. 2 recent trades in the past 30 days. The first was initiated on the 19th of December and was closed for a profit of $1,575. The other one was entered on the 5th of January and was closed for a profit of $1,500. How would you feel about these kinds of results? To know that your paycheck from the market was just around the corner, all from exploiting that hidden asset class in the markets. Now I'm going to try and look at some of these questions. Maybe it's in the chat. Okay. We'll scroll down. Oh boy, I got to go all the way to the bottom. Let's see if I can go all the way to the bottom really quick and see if I can get some answers. Jeanette, if you want to chime in, because there's a lot of questions and I'm actually having trouble scrolling through it.
Yeah, the scroll bar should be on the right. I'm looking at a bunch of answers: ETFs, options, oil. How much was risk? Stocks, options, commodities, ETF, calls and puts.
ETFs, oil, commodities. None of these are close.
I have no idea what the question was because I didn't.
Okay, it's the hidden asset class in the market that can generate sustainable wealth. Okay. My questions box is actually very, very small, and every time I use go to breaks, and this is what we're dealing with right now. Okay, a lot of people are saying stocks or ETFs or oil and other things like that. It's a little bit different. And to get the answer, I'm going to show you a report that was put together by the research department of Goldman Sachs. And this was put together back in, I think, 2007. It's hidden in the depths of the Goldman Sachs research archives. You got to really hunt for it. Okay, you really got to dive deep in Google if you want to find it. And here's what this report said about this hidden asset class: that this asset class can generate significantly passively generated returns, can generate returns large enough to justify non-trivial allocation, and it tends to outperform stocks in hostile markets. Okay, so let's just take the nerd speak of this a little bit. You can make money, you can make a lot of money, and it does well when the market's selling off. That's something, sounds like, we could all use, right? Well, this asset class is called volatility. And learning how to trade volatility is the best way to generate aggressive and sustainable wealth in the market. It's what allows us to earn 25 to 50% per year without a ton of stress, without looking at 100 different stocks and without staring at screens for 6 hours a day. I'll show you how to use this in just a second, but first I need to warn you about something. This strategy is not glitzy or glamorous, but boy, does it add dependable income into your trading account. And it's true. Look, you're going to miss the chase of the next hot stock. You won't wake up to the thrill of a stock you own getting bought out or having some kind of FDA event. You won't be able to brag to your friends about how you nailed the bottom from some kind of Fed meeting or jobs report. In fact, when done the right way, this strategy, it can be kind of monotonous. You log into your trading account every day to make sure the daily income is being transferred from some other hedge fund into your pockets. And then having to check price levels in case you need to make a small adjustment to cut your risk down even further, and then closing your screens and going about your day. You don't need to turn on CNBC. You don't need to check your stock quotes. It's tedious. And after all that, you got to sit down for a whole 15 minutes a day to plan out your next trade and then send out your order. If you're a glutton for boredom, I'm going to show you how to do this in just a moment and how you can get it done completely for you. And it's so non-glamorous, but it may be something that you desire. Dependable, consistent income, even if it doesn't come from chasing hot stock picks and staring at screens for 6 hours a day. Okay, now Dave, I finally scrolled to the bottom of the Q&A box. Who was it? Mike got it. Mike called out volatility. Okay, and Mike, Anderson Mike is saying, yeah, I like boredom. Boredom's nice. You know, boredom's nice. It's steady profits. Are there any other boring folks like me watching this presentation saying, oh, that sounds kind of nice? This asset, trading volatility and using the strategy that I'll talk about today, it can get you a longer retirement. Instead of surviving, you're also thriving. It can get you to financial independence a lot quicker, a lot earlier in life, where you stop losing money chasing bad strategies, chasing hot stocks in the market, and you can let go of being stressed. And you can supplement or potentially replace the income from a full-time job. It sounds like something we'd all want, right? Well, here's the results of this one simple strategy on one simple asset, no complexity, a single underlying index that we're going to be looking at. This is from Trade Alert, starting with a portfolio of $40,000 2 years ago. It's currently up just over, actually it's well over $70,000 now in a 2-year period. Okay, we're up to about $75K. I didn't include some extra trades that we just talked about, those the $1,500 trades that we closed out. Are these the kinds of results that you want to see in your portfolio? Steady, consistent income. But here's the thing, it's not just about what we can do, it's also one more thing. Can I get the same kind of results? That's the question you should always be asking from anyone that does any kinds of these presentations, because someone out there may be an incredibly talented trader, but may not be able to transfer those profitable trading strategies onto you because you may not be able to, they may be too advanced, or they may not fit your own risk tolerance. Okay? So it's one thing to be able to teach that strategy to other people, and it's another thing to trade it for yourself. So I'd like to answer that question from you. Here's from one of our clients, Jim in Virginia. He says, the trading strategy we teach is not a black box system. Sure, there are a lot of very automated points to it, but you also understand the reasoning and the rationale behind each and every trade and adjustment we make. He's up $3,449 in just a few short months. Here's some other clients that we had. I'm up 25% in 5 months with a 6-figure account. Do the math on that. After 6 short months, we're making $4,000 to $5,000 per month. And here's the thing. You have every right to earn the returns you desire. It's just that the traditional approach to consistent income, it just doesn't work, right? The central banks are creating negative interest rate bonds where you have to pay money. You have the dividend yield of the S&P 500 around 2%. You have the 30-year bond around 2%. You're just not going to milk it. So if you are looking for consistent income, you may have speculated a little bit. Maybe you went into oil MLP saying, oh, look, this oil company is going to give me 8% a year, and oil is never going to go down, right? Well, remember what 2014 did and how everyone got smoked on that trade? The traditional approaches don't work, and if you're chasing income, you're going to get burnt as well. Using volatility as an asset class is going to be a sustainable strategy for years because the exploitable edge we use will always be there. Now think about the other side. What if you don't get those results? What would you feel like? If you're still living paycheck to paycheck, if you don't have the right kind of strategy to get true wealth, maybe you get a good string of winners and then you have that one really garbage trade that wipes out all of those profits from the past 5 or 8 trades. And you don't get that growth, you don't get that exponential return curve. And if you're not satisfied with the results that you're getting in the market, that's okay. That's why you're on this call, and that's what we're going to fix today. Okay, so we're going to go into the strategy now. And I know what you're thinking, another webinar where you waste time, looking for the real meat of the strategy, and that's okay. There's a lot of crap out there, but today you're going to get the entire trade strategy. Not just that, you're going to see the pitfalls you must avoid if you want to be successful in trading this strategy. So this is not a get-rich-quick kind of strategy. This is a long-term greedy strategy. This is not a black box strategy, and getting set up will take some work. Okay, you have to front load the work, and once you do that, you can put on this trade within 15 minutes a day. Okay, John is saying, cut the BS, what are you doing? Here we go. Here's the pathway to aggressive wealth building, exploiting a loophole in a hidden asset class known as volatility. And we are going to be talking about today iron condor trading. Now, there are going to be 2 kinds of people on this call. The first are the people who have never heard of an iron condor. You're saying a metal bird, that doesn't make sense. If you don't know what that is, you're in for a treat. Now, the second are people who know what it is. And maybe you've traded them. Maybe you've not been successful with them. Here's the thing, people that know about iron condors, you probably attempted to trade them, but they weren't profitable, where you had that string of winners and then that one bad trade that takes it all out. So I want you to hang on as we bring everyone else up to speed to show you the major mistakes most people make with the strategy and how to avoid it. Okay? So we're going to construct an iron condor. What we're going to start looking at first, this is a price line. Okay? And I've been using this slide since 2013, back when the S&P 500 was trading at 1440. Okay, now that shows you how long I've been teaching iron condors, all the way back, when we weren't trading at 2,300 on the S&P, we were trading at 1,400 instead. So an iron condor is a combination of 4 total legs. The first one is a short put, and a short put gives you limited reward with unlimited risk. And as long as the market stays above the short strike of that put, you're going to make some money. So for this particular example, this is a 1380 short put, and as long as the market stayed above 1380, you're profitable. Now, the problem with this is you have unlimited risk. So what you can do is you can buy a spread to protect your position. So you buy a long put in combination with a short put, and this is known as a bull put spread. Okay, a bull put spread. Limited risk, limited reward, and a high odds trade. Okay, and as long as the market stays above your short strike, you're going to make some money. Now, this is a bullish trade, okay, because we want the price to be higher than a certain point. Well, we can mirror this out, and we can say, all right, we can also do it on the call side. So you can sell a call, and selling a call is limited reward and unlimited risk. Okay, well, we can remove some of that risk by buying a call that's further out of the money, and you limit your risk. Okay, so when you combine this together, you have a combination of a bull put spread and a bear call spread. You put those 2 things together, and this is what an iron condor looks like. It is limited reward, limited risk, but also very, very high odds. This is a high odds trade. Okay, so this is what it looks like in real life. Again, I've been using these slides since, January of 2013, so I've been teaching this for quite some time. This is a limited risk and limited reward trade, and it's a high odds. Now, when people look at iron condors and they say, well, why the heck would I want to risk more than my potential reward? There's 2 answers to that. First off, you should never, ever, ever, ever hit max risk on your iron condor. Ever. Period. The end. You will always need to adjust beforehand. Okay? You need to have an active risk management strategy for iron condors. These are not set and forget trades. Okay? That's one of the huge mistakes that people make when trading iron condors. The second thing is there's always going to be a trade-off between risk, reward, and odds. So higher risk, lower reward, but also higher odds. It's a much more manageable strategy. If you want higher rewards, you're going to have to take a lower odds kind of trade, and you'll have to go chase stocks. Okay? So some advantages to iron condors. You make money based off of a range instead of direction. What that means is you don't have to pick stocks. You don't have to pick a direction of where the market's headed. You don't really have to focus on the Fed. You don't have to focus on what the administration is going to do next. You can go on one single asset, that's the S&P 500, and trade that every single time. And those are the results we get. The next advantage is a non-correlated strategy to investing in swing trading. I want you to think about this. Okay? If you buy a stock, let's say you buy what's Apple trading at? Well, Apple's trading around 120, I think. Okay, you buy Apple at 120, okay? And Apple stays at that exact same price at 120 for the next 3 months. You're going to be left very frustrated, right? Because you want Apple to go higher. You are actually bullish volatility in Apple, okay? Well, with iron condors, you're bearish volatility. You don't really want the market to move a lot. Okay, so it's a non-correlated strategy. You can actually, if you do want to buy stocks or if you do want to invest in swing trade, that's fine. Iron condors will provide you a cash flow buffer in case the market doesn't move. Okay? And it doesn't require a ton of capital experience. I'm going to show you the exact steps we use to initiate iron condors, and you'll see that you just do it every single time. There's no need to look at earnings reports or Fed reports or anything like that. It's just a simple system. Here's a little bit more in detail about that non-correlated strategy. You know, if you trade, swing trade, invest, day trade, whatever, you're long volatility. You want the underlying stock or market to move. That's directional trading. Both income trading, which is iron condor trading, your bearish volatility. These are complementary trading strategies. Okay. So let's talk about target profits. These are the kinds of profits we're looking for. The first off is about a 20% return on risk. Now this is going to be a little bit lower, so around 18%, but that's a good starting off point. Okay, we're looking for about a 20% return on risk. That's how we initiate our iron condors. The target is 50% of the credit, meaning that we do not try and hold on, the iron condor to options expiration. That is a dumb idea, capital D, dumb idea, because if you try and milk the credit out and if you try and maximize the profits out of an iron condor, then the market gods will descend upon you and blow out your trade. I know this from experience. 2013 comes to mind where we had quantitative easing 2.0 and all these other things happened and the market did not have any reversion whatsoever. It is easier to just get your 50% of credit and then roll your strategy out further out in time. So we're looking for about a 10 to 12% return in a 30-day window. Okay, and we're going to talk about a layering strategy so you can get this 10 to 12%, that $500 to $1,000 per month, with every single week. Okay. So here's the very specific trade entry points. All right, so you want to start looking 60 days to expiration. That may seem like a long time, but you want to avoid short duration options. We'll talk about that in detail a little bit later, but you want to avoid short duration options. There are a couple different ways to be consistent in picking the strikes for your iron condor. One way is to use the delta of an option. When I say the word delta, it often confuses a lot of people. So the simplest way to do it is look for a 9% return on risk for each side. And you're doing 10 wide strikes. So, for example, if you put on a bull put spread that's 10 wide and you're looking for a 9% return on risk, that means you're looking for a credit of 80 cents. Okay? Maybe a little bit higher, but 80 to 90 cents. That's where you want to start. And then the bear call spread's the same thing. Normally, because of some advanced things called option skew, you actually get a higher credit on the call side, so you can actually look for maybe $1 to $1.10 on the call side. But you're looking for a $1.80 credit 60 days out. Okay? So here's an example entry. This is from April of 2016. All right? So the 2080, 2090 call spread, 1680, 1670 put spread, credit of $1.80. All right, so as long as the market does not move too far, either to the upside or downside, you're going to make some money. All right. Position sizing, it's really going to be, I really don't like talking about position sizing a whole lot because, everyone's different. If you're trading a smaller account, you're going to have to do more sides. As simple as that. But a good, reasonable kind of idea, 20% portfolio allocation per month. If you're looking to pull about 12% out of 20, you're looking at 2.4%. That means annualized with no compounding, you're looking to get about 30% of your portfolio per year. Now, can this be lower? Yes. Can this be higher? Absolutely. It depends on how aggressive you want to be, what your overall sizing is, and how compliant the market is. But a goal, your minimum goal is 25%. Okay, and then you can go up from there. All right? Now, here's the cool thing. The S&P 500 now has weekly options, but weekly options are kind of dangerous when you go short duration. What's more important here is that they have weekly options going 2 months out. Okay, weekly options have changed the game. Instead of going a ton of size every single month, you can now go and enter a new iron condor trade every single week. This eliminates or reduces what we call duration risk. Okay? Duration risk is a very, very real thing, and then you can spread that risk out. That means at any given point, you can have 4 open iron condors all at once, all at different options expiration cycles, so you can collect that weekly paycheck week after week. Okay, we'll talk more about layering profits in just a second. So do the math really quick. You do a 10 wide iron condor. Your credit is $1.80. You're looking to take about 50% of that. That's about 90 cents. Okay, if you're doing 10 iron condors, your credit's $1,800. You take 50% of that. That's $900. That's where we get $500 to $1,000 per month. Sometimes you get a little less. Sometimes you get a little more. Depends on how the market's moving and how aggressive you want to be. Now, we'll get to questions in just a second, but I know there's one thing that you're going to be asking. If it's so easy, if it's so dang simple, why doesn't everyone do it? There are 2 answers to that question. The first, there is not enough liquidity on the S&P options market to trade this with any kind of size past $20 million. I would even say once you get to about a $5 million mark, then you need to change your strategies. You need to start looking at put sales. You need to start looking at strangle sales as well. Okay. If you look at this, this is an example. This is from the S&P market. You look at the liquidity right here. You know, here the 2110 put only has a 1300 volume going on. Open interest 1700, right? So that's the kind of market we're dealing with. Because we are not dealing with $5 million accounts, we can get in and out a little bit faster than what the hedge funds can. In fact, the hedge funds are the things that are paying us. They are the institutions that are raising this premium, and we get to collect it this whole time. This is a chart of the implied volatility, so the premium available in the options market relative to the actual volatility that happens. And most of the time, you're going to get nice premium. Okay, now there are certain pockets in the market where we see volatility pick up. Okay, and if you don't have an active risk management strategy, that's where you get smoked. But most of the time, okay, it's going to be a profitable strategy. The second answer to this question, if it's so easy, why doesn't everyone do it? Well, that's because there are poor execution strategies out there. So the idea is sound, but the execution is bad. That's why I say iron condors are not a bad strategy. Most people are just bad iron condor traders. Here's a great example. This chart proves what happens if you don't trade iron condors the right way. This is a benchmark index from the Chicago Board of Exchange, a SIBO, and it tracks the performance of trading iron condors. Now you can see the example right here where you get this nice slow stair-step pattern and then you get knocked down. The nice slow stair-step pattern and then you get knocked down. And if you look at this, if you traded this started back in 2006 and you traded this strategy, you would be break even. In fact, this really, really big thing right here, this move right here caused a lot of iron condor trading services to close up shop because they got smoked because they were trading poorly. Okay, there were a lot of garbage iron condor traders out there that did not recognize the true risks in the strategy and got smoked. Okay, well, I'll show you how to avoid that. We traded this. We did lose money during this period, but because we kept our risk low, we kept our skin in the game. Okay? 10-year period. If you're trading this strategy, didn't make any money. All right? So here are some mistakes that you must avoid as an iron condor trader. Mistake number 1 is holding the options expiration. If you've ever seen this chart before, this is the theta curve. Okay, it shows the time decay of an option. Okay, remember as time goes on, the perceived risk of a market goes down because there's less time involved in that option contract. So a lot of people look at this and they say, oh, it's obviously exponential right here. And between 30 days and 0 days, that's where we get the milk of the option premium. This is a misleading chart. This chart is a lie. Okay, because this only looks at the money options. With iron condors, okay, at the money simply refers to options where the strike price is close to the underlying price of the market. We're looking out of the money options. Out of the money options trade like this, where the majority of the premium goes between 60 days and 30 days. And then after that, it becomes sticky. The premium becomes sticky because if you're a market maker, you're not going to allow yourself to sell options at a 0 bid. It doesn't make sense. That premium stays sticky, especially on out-of-the-money puts. And so it is better to close between, open at 60 days, close around 30 days to expiration. Okay, that is the sweet spot for these kinds of trades. Another nice little tactic is to use good till cancel limit orders. Okay, this is just a simple strategy to help to automate your trades, and you want to leg out of your trades. You don't have to go all out. So you have an iron condor like this. Excuse my chicken scratch. I'm using a mouse to draw right here. But let's say the market rallies a little bit. Well, you can take profits on your put spread, okay, and then maybe the market sells off a little bit, and then you could take profits on your call spread, and just like that, you're out of the trade with as little risk as necessary. Remember, the goal of financial speculation in any kind is to earn as much money as quickly as possible with as little risk as possible. It does not make sense to try and hold this sucker all the way to options expiration, because the market gods will descend upon you and you'll get smoked. Okay, because you'll say, I know what you'll do in your head. You'll say, oh, as long as the market doesn't rally 5%, I'm going to be fine. Well, as soon as you say that, the market gods will say, oh, really? And then the market will rally 5%. And then you'll get stuck on something that I call the gamma knife edge. It's where you get gamma heartburn. And it is not fun. I've been there. It is not pleasant to be around. And I'm trying to make sure that you avoid it. The next mistake, waiting for fat premium. I see this a lot where investors and traders and gurus out there will say, oh, this is the chart of the VIX, and you say, oh, I want to sell premium when it is high. When the VIX is above, let's just say 17, that's when you get the best rewards for iron condors. That is a lie. In fact, when you have a low VIX, it also means that the actual volatility in the market is down. Okay, a great example, starting in December, when you have a VIX sub 12, right? Well, think about what the market has done over the past 2 months. It has gone sideways in a 25-point range. So if you said, oh, I don't want to sell premium because the VIX is low, well, you've missed out on gains, because it's not just about the VIX. It is about the actual price movement of the market. And when we have a low VIX, it leads to low actual movement. Okay? The other reason why you don't want to wait for fat premium is this. When you initialize iron condors, they tend to start net short. That is a function of the structure of the market. It is a function of the skew in the market. So if you sell an iron condor with a very high VIX, what happens when the VIX is very high? Generally, the market bounces, and then you get smoked. The losses, the biggest losses we've had with our service is when the VIX is high and we don't respect the upside risk. In fact, the upside risk is the biggest risk in the market. Okay? Mistake number 3, short duration iron condors. It does not, okay, there's a very good phrase that I like to use here. Is the juice worth the squeeze? Is the juice worth the squeeze? When you sell short duration options, that means iron condors that have 10 days, I'd even say under 20 days to expiration. You will not get enough premium to justify the risk involved. Now, I'm sure that there are profitable weekly short-term iron condor traders out there, but I have seen services and gurus, especially during August of 2015, during that China currency crisis where the market sold off hard and then it rallied aggressively. They closed up shop because they got smoked, they got blown out. That's what you want to avoid. The juice is not worth the squeeze. It is, you are going to get better risk-adjusted returns going further out in duration. There's also something involved called the term structure risk of the market, meaning that as we get closer to options expiration, we have a better idea of what's going to happen in the market. So premiums will be lower. If you go and you look at the implied volatility on weekly options, it's currently sitting around 9%. If you go further out in time, say 60 days, you're looking at 15%. Okay, you want to sell a 15 vol and not a 9 vol. Okay? One more little technique is to layer your trades with the introduction of weekly options. You can put on 4 different iron condor trades, And then you can start exiting between 30 and 21 days, which means that you can collect your weekly paycheck of $500 to $1,000 per week, every single week. I'm going to go through some questions. I'm going to, come on, let me maximize this. Let me see if I can get this going, because my questions box is tiny right now. Okay. Cliff is saying, what is your stop loss procedure? That's a great question, Cliff. Let's go back to this example. If you hit a 1.5x credit loss, then bail. Okay? There are two kinds of capital that you deal with as a trader. You have your financial capital, that is the money in your brokerage. There's a second kind, psychological capital. There are ways, there are adjustment techniques that you can do to work a losing iron condor trade back to break even or potentially profits. But after that time, your psychological capital will be depleted. I'm sure if you're a directional trader, you know exactly what I mean, where you buy a stock and then it goes down, you don't respect your stop loss and then it goes down further, and then you average in and you try a couple different ways to get back to break even. A lot of people do this with selling puts, where you sell a put, and then the market drops, and then you roll the put out, and then you roll the put out, and you roll and roll and roll. Sure, you eventually made money, but your psychological capital is depleted. So 1.5x your credit, just get out and move on to a new iron condor trade, because it will be easier to regain your losses in a new iron condor trade than trying to claw your way back out of the hole. Okay? All right. Bill is asking, was that big drop due to volatility jumping and taking out short strikes? Yes, if we go back to, where was it? Okay, so the SIBO benchmark, this big drop right here was directly related to the China currency crisis, where they did a surprise adjustment and the Chinese currency significantly depreciated against the dollar, and it came out of nowhere. And then the market dropped. The market dropped 3% in a day, and the Dow Jones went another 600% in a day, and then we had that 1,000-point day to the downside. Now, that, believe it or not, dealing with large moves to the downside is much more manageable with iron condors. It is not that problem. It is when you initiate an iron condor into the hole and you do not respect the upside risk, because you'll get smoked. So the upside risk is the biggest risk with iron condors, and if you don't have an adjustment plan, you're going to get smoked. Okay? So yeah, that big drop was directly related to the big move, not just the move to the downside, but the move to the upside after the Chinese currency crisis. Avi's asking, how do you manage the risks when one of the legs gets into the money? Avi, that's a great question. He's asking, well, what do you do if the market moves enough to get one of your options, your short strikes, in the money? There is a phrase that I use where the best defense against a nuclear bomb is not to be there when it goes off. If you do not have an adjustment plan in place that is proactive and anticipates those moves, you will be stuck in a position that you don't want to be in. Okay? We do not wait for the market to get that far before we adjust. Basically, our adjustment comes, let's just say the market rallies 30 points, we buy a call to hedge, and then if the market continues to move, we sell that call for profits and use that profit to pay for the cost of the roll to the upside. And then if the market squeezes even further, then we just cut our losses. Okay? Our adjustment plan is very simple. We do not allow the market to get that far. Okay, now you may be saying, well, what if the market crashes, right? When you initialize an iron condor, 60 days out, you're going to have 200 points of cushion to the downside. Okay, so yes, if the market crashes 10% in a single day, you're going to be in a lot of trouble. But the odds of that happening are incredibly low, like incredibly low. Okay, normally what happens is the market will have sold off 3% beforehand, and you will already have an adjustment plan in place. And then if the market crashes 10%, you'll actually be at a profit because you were smart about your adjustments. Cliff C is asking, do you leg into the trade? I don't like legging in terms of trying to be sneaky and trying to pick a direction right here. If you are, the only reason that it makes sense to leg into a trade is if you have liquidity issues. Okay, so I recommend using something called a blast all order template where you simultaneously send out orders for both the bear call spread and the bull put spread. Okay, there's generally enough liquidity that it doesn't matter. Now, Kurt's asking, do you trade the SPY, the SPX? We look at the SPX. There are cash advantages to SPX. There's Section 1256 contracts, which means 40% of the gains are long-term taxed, at least in America. Okay. Let's see, what else? Other questions. Did you mean that you don't take earnings into consideration when placing an iron condor? GV's asking, do we take earnings into consideration when placing an iron condor? The beauty is we don't care. Because we're looking at just one asset, the S&P 500. We don't care about what Google does. Okay, we're not putting iron condors on a bunch of different stocks. It's simple. Okay, and here's the thing. There's something called volatility dispersion, right? And there's dispersion risk, or the lack of it. If you put on iron condors in Google and Apple and Exxon and the Russell 2000 and the NASDAQ and the S&P, you're not diversified because if the market sells off, everything goes. You're going to be on one giant conveyor belt. You're not going to have diversified risk. Okay, dispersion does not stick around. Okay, if dispersion simply doesn't stick around if the market sells off. I'm continuing to go back further in the questions. AI is asking, I wish you would avoid naked money amounts not meaningful without percentage return on capital at risk and time frame. Just saying, we already talked about percentage return on risk. Okay, that's actually how we enter our trades. That's our enter function. Okay, and I'm going to scroll all the way down. Stop loss procedure. All right, cool. All right. Can you please tell me how to make adjustments? All right, so I'm just going to do this really quick. I don't have it in the presentation, but I'm just going to do it for you really quick. Okay, and this is kind of a quick setup. This is a quick hack. We're going to open up MS Paint. Okay, now let's see if I can work my magic. Let's say you start off with an iron condor like this. Okay, and this is your break-even level, right? And your actual risk, your T plus 0 risk, is going to look something like this. All right, now let's say the market rallies. Let's say the market rallies and you have your first adjustment point here. What you do is you go 45 days out, okay, and you buy a 9 delta call. You buy a 9 delta call, and you size up enough to take out half of your net delta. Okay, so if you're doing 10 iron condors, you normally start off with around 10 delta short. If the market rallies, maybe you end up at 15 delta. So you normally only need about one of these. Okay, and it's simple. We just use a call. We don't try and do anything fancy. And what that will do is it will flatten out your profile right here. Okay, and then what happens if the market continues to rally? You take profits on that call. And then what you do is you use those profits to roll the losing side up. Normally it's about 30 points. Then you want to roll higher, 30 points. And what you'll find is that, it doesn't take much for this adjustment to trigger. Okay, we want to be very proactive. We want to be very aggressive with our risk management strategy. Okay, so that's how you do it. Jeff is asking, how many of each iron condor is profitable? I'm going to try and answer that question really quick. It may take, let's see if I can get to it. Everyone bear with me because Jeff asked a great question. He's asking about our track record. We showed our track record all the way back at the top saying, all right, you want results, here's the results. All right? So I'm going to hunt it down really quick, and I'm going to show you our results. Let's see. I got to get our spreadsheet out. Just give me 1 second. I think this is it. This looks like it. All right. So we track our trades like so. So 2015 was right here. The green ones are winners. The red ones are losers. All right. The big losers that came in right here, that was August of 2015. You can see that we did lose money, but we kept our risk low. All right. So the green ones are winners. The red ones are losers. Here's 2016. The green ones are winners. The red ones are losers. Then here's 2017. We haven't lost yet. Knock on wood. Okay, and we don't, we care about losses, but we care more about keeping our losses down. Okay? John's asking, how do you handle gap downs and gap ups? We adjust. If you look at how the S&P 500 trades, it's a very rare occurrence, especially when we're trading at all-time highs. You don't see massive gaps. When you see massive gaps is after a sell-off has already occurred. Okay, and there are different techniques you can use after a sell-off has already occurred so you can manage your risk. Bob's asking, what underlyings do you trade? Just the S&P 500. What does X stand for? I'm not sure. All right, Arthur is asking, so you use weeklies, avoiding this and next, instead using further out. Yes. Okay, so I'm going to double check on this slide really quick. All right, so our mistake number 3, we use weeklies, but we do not use short duration weeklies. Okay, we want to avoid short duration iron condors, but we do take advantage of weekly options. Okay. Anderson is asking, do you prefer to enter a trade on a down day or an up day, or it doesn't matter? We do updates. Remember, look, iron condors, as they start off, are net short. They always start off net short if you're doing an equal leg iron condor. So it is easier, and you will get better fills, and you will get better prices, and you'll get better liquidity if you enter iron condors on an up day. And there's actually a different strategy we use. This is the IC base strategy we use. We also have something called an IC plus, which is an even odds iron condor that we use in very specific overbought circumstances in the market. We're just waiting for the market to get overbought. Okay. Jamie's asking, when you do the trade, how do you convert the stock option or the stock price and the option price? We don't look at the stock price. Our entry is a function of our return on risk. Now, our return on risk is 8% on either side. That generally rounds out to a short delta, short option delta of around 10. Okay, 12 to 10. Okay, so we don't care about the stock price. P. Sims is asking, do you only trade the SPY or SPX or what? Yes, we only trade the S&P because we don't need to trade anything else. If you trade a bunch of different iron condors, if the market goes to shit, it's all going to be one giant short gamma position. It doesn't matter how clever you were with the trades, all right? If you trade the S&P, you're going to get, right, the same thing, okay? Peter's asking, is the stop loss, is it 1.5 the credit per each or for the entire position? It's the entire position. So we look at this credit, and this credit's going to be around $1.80. Okay, so $1.80 plus 90 is $2.70. So if we end up at a loss of $2.70 per spread, we're bailing, and we're going to work on some new trades, to get better profits. Normally, what happens is that if we stop out of this trade, the profits come very, very quickly for all the other trades. Because think about it: when you have a big loss on an iron condor, it is due to a trend. It is due to a very large trending volatility movement. And that only happens a couple times. There's a fancy term called heteroscedasticity or something like that, or volatility clusters. So after a high volatility event, you get stopped out, and then there's normally a low volatility event. Great example, we had the election, the market ripped higher, we lost money on an iron condor due to the election, moved to the upside. Well, immediately after that, the market didn't do anything. And it's gone nowhere for, 2 months now? And we've made our profits back. And then some. Okay. Vinod is asking, do you adjust using a delta at 70%? No, we look at our short delta. If our short delta goes to 20, then we bail. Okay, either on the put side or the call side. Okay, that's generally going to be about 40 points to the upside and about 50 points to the downside. Sometimes more, sometimes less. Those are tight adjustment points, and that's intentional. We want to be very early when we adjust. Dave's asking, why not just do a Jade Lizard where the majority of the risk is to the upside? Here's the thing. Jade Lizard was invented. That's a term invented, I think, by Tasty Trade and those guys. And guess what? They love that risk to the upside because they're always bearish. Well, I don't want all the risk to the upside because we're in a bull market. Here's the thing. I don't want to get into it too much, but basically the option skew means that you're always going to have risk to the upside. Okay, I don't want to increase my risk to the upside. That's a very bad idea. if you go through life expecting the crash or some kind of a big move and you're always trying to protect yourself against a big move, you're not going to make a whole lot of premium because that's where the premium is. Okay? You got plenty of upside risk. You don't need to increase it. Right? It is easier to manage an iron condor on the downside than it is to the upside already. So I'm not going to try and increase my risk. Okay. Someone's asking for data, and Robert's asking, you pay a lot of commissions when you don't just let a winning spread expire. That's the cost of playing the game. Because if you say, okay, I'm just going to hold it all the way to expiration, that's going to work a couple times until you get that one time, well, that loss is going to be a lot larger than the commissions you're paying. Okay? All right. Someone's asking if your all right. So if your goal is 10 to 12% a month, and your two-year results are 2.36% per month. Okay. So let's go back. I got to hunt down this slide. Someone's asking if you're looking for 10% returns, then why are you not getting 100% on your portfolio? And that's a very simple answer. I just got to find it. Because our target profits, maybe it's not that one. We're not looking to go all in on an iron condor. Okay, so if you're looking to get 10 to 12% a month, right, sometimes more, sometimes less, and you allocate 20%, okay, then that's where you get your 2.4%. So you're not going all in on an iron condor all at once. Again, position sizing matters differently for different people, okay? So just keep that in mind. George is asking, if you can take off less than 50%, so he's asking, our target is 50% in a 30-day period. Well, George is asking, what if you can get 25% in a 2-week period? Yes, there's a very specific set of calculations we use. It's linear in nature. If we can pull out 10% in a week of our credit, or maybe a little bit higher, 15%, then we're going to do it. We're going to move on to the next month. Okay, there are some instances in which the volatility comes in a lot faster, and we take advantage of that. Again, the goal of financial speculation is to earn as much money as quickly as possible. All right, so we're not looking to get 50% every time. If we can get it faster on a linear basis, then we do. All right, so Alexander's asking a good question. I understood you could not leg out of an iron condor if you place the order together as a condor. To leg out, would you have to leg in? No. You can go all in on an iron condor and then do separate legs. So there's one thing you can do. You can do a first, this is an advanced order, a first triggers sequence order. Okay, so you'll put the iron condor trade out, and if it gets filled, then immediately you get 2 separate trade orders, one to close the put spread and one to close the call spread. And those orders only go out if that first order is filled. Okay, and you don't want first trigger sequence, you want first triggers all in this case. All right, so once the first order gets filled, everything else underneath, that order gets floated out. And remember, you want to use good till cancel limit orders. Okay, good till cancel limit orders. GV's asking, do you use HER to know where to place the strikes? No, we use return on risk. You can also use delta, but it's touching different parts of the elephant. Okay, we're still looking at the same elephant. Dave's saying there's pretty heavy stuff. He already left, so that's fine. Cliff's asking, do you sell a course that goes into the adjustments in more detail? Well, you're in luck. We'll talk about that in a second. Trevor's asking, how long do you keep that long call? So for that adjustment point, it gets a little tricky. That's where we get into discretion. But basically, if our delta goes flat, normally if we're looking at an upside adjustment, about another 30 points to the upside is when we're looking to bail on that hedge and then roll. It doesn't take a whole lot. Dave's asking, do you have a service that does a trade? Well, Dave, you're in luck. Just give me a second. Dave's asking, trade with index ETFs. You can translate the SPX to the SPY. The SPX is a little larger and, in my opinion, has better tax advantages and some other things like that. Okay, William's asking, I noticed the Russell 2000 on your spreadsheet. You trade that as well. We decided to just focus on the S&P 500. We don't trade NDX options. They're too wide and the spread strikes are too wide. We can look at RUT if you want. We've got a chat room where you can ask a ton of questions. Okay, Dave's asking, do you sell 30 Delta Iron Condors in very specific circumstances when the market's overbought? Okay, Dave Patterson, there's a lot of Daves on here, is asking how much are you risking on each trade to get the results shown on the slide? 20% of your portfolio. Okay, we're going to move on. A lot of these are answered in the frequently asked questions I'll talk about in a second. So, hopefully, and it sounds like it, everyone got some insights into iron condor trading. Even if you knew what iron condor trades were, odds are you had some success with them and then you got smoked on one bad trade. Our job at our firm is to make sure that you don't run into that problem, because iron condors, about 68% of the time, are very forgiving strategies. It's a very forgiving strategy where you just get in, you get out, and you take your profits. It's that extra part where you need some help. Okay? So, let's recap. Where you are now, if you're on this call, you're frustrated by these returns. You want more consistency with less risk. You want to earn $500 to $1,000 per week. You want to make some more money. Okay, that's where you are now. Here's where you want to be. Get the ability to get extraordinary returns without extraordinary risk, not needing to pick stocks, not needing to stare at screens for 60 hours a week. Less stress, happy portfolio, happy trader. So iron condor trading can get you there. Now, it's not always a straight line. Here's how I did it. Okay, lots of mistakes along the way, and if you go out on your own, you will eventually become a profitable iron condor trader, assuming that you don't get blown out. Okay, what we want to do for you is get you from point A to point B as quickly and straight as possible. So here's exactly what you need. Okay, the first thing, you need to be able to trade iron condors. You want to learn how to trade iron condors and using our system. You need some real-world experience. How have iron condors traded in the past? You need some iron condor trading tactics. You know, we talk about the blast all order and the good till cancel limit order and trading in market rallies. Those are some nuances that will get you that extra edge. And not just that, because yes, we can teach you to fish, but sometimes you just want the stinking fish sent to you on a platter, cooked, filleted, breaded in some lovely breadcrumbs. I'm really hungry right now. So you just want to trade straight up. And then you want to be able to ask a bunch of questions live. Okay? I want to introduce you to Income Lab. This is our iron condor trading service. That's where the results that you saw, that's where they came from. Okay? We've been doing this for 2 years now. We've got plenty of results. We've got a track record that went through that stupid China currency thing where all the other iron condor traders got blown out of the water. We still lost money, but we did not get blown out. Okay, so we have a track record that's gone through market crashes as well as market rips. Okay, these are the results, turning a $40,000 portfolio up into 70, I want to say 75, maybe 78. So here's what you're going to get. Okay, we went through that success roadmap. First, you're going to get the Iron Condor Bootcamp, the exact framework we use in under 60 minutes. The entries, the adjustments in more detail, and the exits. Okay, the adjustments are always going to be the tricky part. You know, where we talked about that 9 delta call or put 45 days out, if our net delta hits 50%, you know, if our short delta on either side hits 20, that whole framework will be set up for you. Okay, now think about this. If all Income Lab did was give you one good trade, would it be worth it? I think so. If all it did was help you pick the best option spread, I think it'd be worth it too. If all it did was to teach you to avoid those costly mistakes, to avoid that one ugly trade that blows you out, it'd definitely be worth it. Okay? So let's go back to our roadmap. All right? With Income Lab. Okay, we'll talk about this in a little bit more detail. So the education, how to trade iron condors, you're taken care of, right? We're going to give you the boot camp that teaches you how to do it quickly and some key tools to use with analytics. Now we go into Income Lab. We have case studies, how iron condors have traded in the past. We've got trading tactics, and we've got some videos set up for you. With iron condor trading, inside of Income Lab, you're also going to get the live trade alerts, and you're also going to get a trader chat room so you can pop in and ask a bunch of questions. Okay? What's one winning setup worth to you on this strategy? What if you get one good month of trades? If you could earn $500 to potentially $500 to $1,000 per week, and you do that for a month, you're going to be set up, won't you? What if you could do this and be consistent for the entire year? You know, we talked about that magic box. How much would you pay for a magic jack-in-the-box that would give you a stock that went up about 10% every single week? Okay, this is an investment that would pay for itself many times over. Okay, here's an example of our income trader chat room. You can go and you can ask as many questions as you want. We send out the trade alerts via email. Then, because if you're a brand new iron condor trader, you're probably going to get confused about something. You log into the chat room, you ask a bunch of questions. You get help with execution. There are people that have been with us for years. They will also answer your questions because they had the exact same questions you had when you got started. So, to get started today, it is only $99. You're going to get 1 month of Income Lab. You're also going to get the Iron Condor Bootcamp. You'll get Iron Condor Trade Alerts, the chat room, Iron Condor Trading Tactics, and a lot more. Go to investingwithoptions.com/go. I'm willing to give you a value on it because once I believe you become a client with us, you stay for life. And we do have other courses available for a handful of other option trading strategies that are profitable strategies. And once you see the trades we do and the teaching style, I believe that you'll be with us for a long time and you'll be looking for ways to expand your horizons. That's why we're doing such a low introductory price. I'm passionate in helping you generate aggressive and sustainable wealth in the options market, and I can't wait for you to get started. So to get started, simply go to this link. It should be in the chat box now. Investingwithoptions.com/go. That will take you to our secure order form where you enter your name, email, billing information. We will create an account for you. You'll get instant access to the bootcamp. You'll also get instant access to the Income Lab. You can sign into Income Lab. You can look at our open trades. You can look at all of our past trades going back for the past few years. Okay, so if you're ready to get started with a trading framework that shows you how to beat the market without needing to time the market, with better returns, less stress, and more free time, then you want to get started. Here's the thing. I do not offer a traditional guarantee. Okay, so if you want to say, I just want to buy it, and if I don't like it, I'll return it, I don't want to deal with you. We have too many people for me to personally deal with that kind of customer support. Okay, so once you're in, you're in. I don't want any tire kickers, no looky-loos or anything like that. I'm looking for regular folks who are ready to build aggressive and sustainable wealth in the market. We do have one guarantee that I think you'll really like. If you're not profitable within 3 months, I will sit on the phone for an hour with you and figure out what's going on. Because it's normally not an idea problem, it's an execution problem. Okay? So to get started now, just $99. Go to investingwithoptions.com/go. I'm going to try and answer some more questions. John Johnson's asking, are ICs always balanced around the current price? No. Iron condors are never going to start off balanced, and that's because of the option skew. You're normally going to have 100 points to the upside and 200 points to the downside. That's why you're going to have that upside risk. There's a very specific reason why that's structured like that. Has to do with the option skew. Okay? Kay is asking, can you please show an example of how you would do an Iron Condor live? I don't have any kind of live platform on right now, but if you email me, steven@iwmail.com, then I will show you an example. How did you adjust the Iron Condors when the China devalued? Mike, we actually have a very specific case study for that. If you email me, steven@iwmail.com, I'll send you that PDF that has the exact steps we used. I won't lie to you, it was an absolute train wreck of a trade. That's because the market went down 1,000 points in a single day. Okay? Tom is asking, is there always an opportunity every week in the S&P 500 for Iron Condors? Generally, yes. If we're into the hole, then we will go unbalanced to the upside. So if the market is sold off aggressively, we manage our upside risk a little bit more. Patty's asking if there's a recording this. Yes, there is. Arthur's asking, what original account balance in the profit spreadsheet that you used? 40K. Starting with 40K, took it to about 75K. Okay? Now, Arthur's asking the real question, and I actually think I have it on the frequently asked questions, what kind of account size do I need? If you're starting off with $1,000, it is possible you need to move to the SPY instead of the SPX, but you cannot expect your account to double overnight. Okay? This is a long-term greedy strategy. For you to get any kind of oomph, starting with $5,000 is a good bet. If you're doing 10 Iron Condors, your initial needs to be about $8,000 per set. Okay, now this is a scalable strategy. You don't have to start with 10, you can start with 5. Another question, how long is my membership good for? So the Income Lab, our goal is to 10x your returns every single month. So starting off with $99 a month, if you can earn $1,000 a month, then we've done our job. Okay, you get the Income Lab Bootcamp, Iron Condor Bootcamp, lifetime membership. You can go back to it as many times as you want. Income Lab, the chat room, the trade alerts, and everything is a monthly service at $99 per month. Okay, to get started, investing with options /go. Another question, will you tell me when to take the trades? Yes, we send out email alerts, and we also have a trade alert platform that you can go back and look. We tell you the exact duration, the exact strikes, the exact prices. Sometimes we don't get filled, and then we will send out an alert for new strikes. Okay? Vinod's asking a great question. I don't have an answer to it. How many trades do you adjust on average in 12 months? I'm going to say about 1 out of 4. That's just off the top of my head. I don't have it exactly down. Do you only use iron condor strategy? Yes. We don't need to diversify strategies because this one's working. We do not want to overcomplicate things. I'm a big believer that focus brings growth. Okay? Sunil's asking, how do you make money on the other 20%? So we talked about, using 20% of your portfolio per month. You can use more if you want. You can crank it up to 30 or 40%. But remember, we're dealing with 4 sets of iron condors. You know, if you do 20% allocation on 4, that means you have 80%. Then you got 20% of dry powder just in case you need adjustments. Okay? So that's why we look at that lower position sizing. Also, a lot of people have other trading strategies, covered calls, put sales, spread sales, swing trading, day trading, and so we try and be a little bit more conservative on the position sizing. Okay. How many strikes above and below the SPX you're starting with? It's going to vary as a function of volatility. Generally, rule of thumb, given the current volatility market right now, it's about 100 points to the upside, 200 points to the downside on the S&P 500. Carl's asking, what do we do if volatility skyrockets? What are you talking about? Volatility is never going to skyrocket again. The market's never, ever going to sell off again. You know, we're at all-time highs. It's never going to happen. Great question. All right, so what do we do if vol skyrockets and the sold option part of the condor starts becoming a loser? Okay, there's not as much vega risk. There's not as much volatility risk in an iron condor as you think. The actual risk is the delta risk. So if volatility rises, that means the market's selling off. That means you're going to make a little money from the delta. Okay, the downside risk is not what you have to worry about. It is the upside risk. Every single stinking time. You know, the way you lose money is when you're always bearish. Because there are a lot of option traders out there who are like engineers like me who are always skeptical, who look at valuations, like they look at the CAPE ratio, the PE ratio, or something like that, even though those valuations don't matter on a 2-month basis, right? And so if you're perpetually bearish and you're always worried about the downside, I'll be honest with you, the downside isn't as huge of a risk on iron condors. It's much easier to manage, much easier to adjust compared to the upside risk. Okay? Jeff's saying, yeah, you lose 270 and then it takes 4 trades at 90-cent profit to make money again. Yeah. So that, you know, you're always going to have, I wouldn't say it's a rare occurrence. You're going to have about 2 of those big losses per year. Okay. But it does not take that much time for it to get refreshed. Okay. Now, I would rather take a 1.5 times credit loss versus a full loss, because you take a full loss, it's going to take a very, very long time for you to make that money back. John's asking if the service is auto trade. No. Okay, you and you alone are responsible for your profits and losses. Okay. P's asking, do you enter and exit the call spread and put spread at the same time? We enter iron condors all at once. When the opportunity presents itself, we will leg out of the trade. Norm is asking the tax differences between the S&P. Okay, so you have the SPY, right, and then you have the SPX. The SPX is a cash-settled index. It's also known as a Section 1256 contract. And there are specific tax advantages where you have a 40%, 60% split. So the 60% is short-term gains, and then the 40% is treated as long-term cap gains. Now, that starts to matter after a while, okay, once you start trading in enough size. Oh, we have a testimonial from Mike. Mike's coming in. I had more time to trade in 2015 when I was with your Iron Condor service. I love the IC service, but you also had a bunch of other great option trades. Is that service still available? We have another spread selling service that, if you want, contact me. We'll talk about it. William's asking, do you always trade 10-point wide spreads? Yes. All right. Vinod is saying your webinar is the best one. I've attended with lots of useful information, real-life trading examples. If you like this, just wait till you see what's on the other side. Okay. Trey's asking opinion on chicken iron condors, 20 to 25% return on risk on each leg, usually an earnings trade. We will do low probability iron condors or even odds iron condors when the opportunity presents itself. There's another strategy that we haven't talked about today. It's called, we have two strategies we use. The first is called the IC base strategy. And that's the one we've been talking about today. The second one is called the IC plus strategy. And the IC base is a normal iron condor, okay? And then the IC plus is what we call a LPIC, also known as an even odds iron condor, where we're looking to risk about $5 and earn about $5, and we have very specific risk management parameters. This trade only happens after the market is sold, after the market's rallied aggressively. So if we see a little bit more of a pop into next week, we'll be looking at one of those. Okay, that's a 30 delta iron condor. All right, William's asking to earn $500 to $1,000 per week. How much does starting capital does one need? Starting with about $30,000 to $40,000. Okay. Let's see what else. How long is Income Lab valid? We use a monthly service at $99 per month. Look, you're going to get, if you buy the Iron Condor Bootcamp right now, that normally costs $99. So you buy it now, you get Income Lab for free for a month. Now, if you hate it, if it's not for you, then just cancel after a month. No questions asked. Well, I'll probably ask you a question because, you know, I like you guys, and I don't like to see you leave. So, you know, we'll ask you a couple questions, but, you know, we'll end your membership there and we'll part as friends. I'm confident that once you see you can 10x the value of Income Lab, then you're going to stick around for a while. Okay? Not the price, cost of trade room. All right. Kay's asking, I'm interested, we'll join, but we'll need to see your last open trade. Okay, all right, let's just go ahead and pull it up. Let me see if I can, pull this up really quick. So I'll show you the back end to show you exactly what you're going to get with Income Lab. Okay, hopefully I don't have to log in. All right, so here's what you get. This is Income Lab. All right, this is the list of all of our past trades, and it goes back, you know, there's 20 things, there's 6 pages, so you can go back through them all. Our open trade summary, we've currently got 1 trade open, okay? The 17 March Iron Condor, currently the 2130, 2120 bull put spread, 2370, 2360, 2370 bear call spread, this is what it looks like. We've already adjusted this to the upside because the market rallied. Okay, and we knew it was going to happen. The market had gone nowhere for 2 months, so we knew our first adjustment was going to happen. If we see about another 30 points higher, then we're going to close that hedge for a profit, and then we're going to roll the call spreads higher, right? It's probably going to be profitable. Odds are, you know, I can't guarantee that, but that's what we're looking like. Okay, now you can go in and you can ask a bunch of questions right here. You can also go into the trading room. You can click on the trading room button, and then you've got a chat room right here. And you can go in and you can ask a bunch of questions in there. All right? And then what you can do is, if you want to watch the Income Lab Bootcamp, you go to the Iron Condor Trading Framework, and there it is. Okay, you can watch all of that right there. And then we've got some Income Lab Tactics, where we talk a little bit in detail about the trading framework, finding your adjustment points, setting adjustment alerts, and Thinkorswim so you can automate this a little bit more. Okay? Let's see. All right, monthly cost, yeah, $99 monthly cost. Yes, there will be a webinar replay. Okay, you say get started. All right, so the way that this is structured, you get instant access to the Income Lab Bootcamp, and then you get 30 days of Income Lab for free. After that 30 days, then it's going to be $99 a month. What broker should I use? Interactive Brokers has really good internal routing. They have a little bit more liquidity than everything else. Otherwise, you can use anything that uses a spread selling system. Ideally, you need to have some analytics involved. Okay? Can I use this in an IRA? Yes, you can. You just have to get it set up right. Let me just go through and run through any other questions. All right. Michelle asks, how can we see your performance record? We've already gone that in detail. Yeah, it's $99 a month. Again, we believe that we can 10x the value of that. Bob, we don't do text alerts. This is not a service that requires text alerts. This is a boring service. Okay, so you just check the emails. Penelope is asking, does the IC Bootcamp include strategy, adjustment strategy instructions? Yes. The cliff notes is if a short call or short put on your iron condor hits a delta of 20, then you want to go out 45 days, buy 9 delta, either call or put, to cut your delta in half. After about another 30 points stretch further, you use the profits of that hedge to roll the spread further. Cindy's asking, do you recommend trades during the learning period? Yes, this is a teach you to fish program, but also we give you the fish on a platter already cooked. All right, so we're going to teach you how to do it. If you want to just get the boot camp and then cancel, that's fine. You can go trade on your own. You can use our framework as much as you want. But if you want the trades directly, then you can. And if you get confused, you just go in the trade room and you ask a bunch of questions. Richard's asking, are you fixated on iron condors only? Also, I'm a retired engineer. Yes, I was a terrible engineer. I was a terrible employee. Yes, we only do iron condors because they're, focus brings growth, right? You don't have to do anything else. Now, if you want to branch out, I've got some other educational products and I can work with you with some other strategies. That's not what we're talking about today. Kurt's asking, what's the advantage over a vertical spread? All right, so if you sell a put spread or you sell a call spread, that means you're picking a direction. We don't know where the market's going to be in a month, right? What we're doing here, we're not doing directional trading. We're trading the hidden asset class called volatility. Okay, so if you want to trade directionally, that's fine. There's nothing wrong with that. You can sell spreads. That's great too. P is asking, do you enter the calls and puts at the same time? Generally, yes. If you have liquidity issues, you can do a blast all order on both the call and put spread side. Steven is asking, is this a special price right now? Can I pay after the seminar? I'm not going to do any sales tricks on you. Look, this is going to be available for as long as you want. Okay? All right. What else do we have? I wish I could figure out how. All right. Monthly cost, again, $99 per month after that. But if you cancel, and I don't want you to cancel, I like you guys, and I think you'll like it too. You can 10x the value pretty easily. But if you want to cancel, that's fine. You get to keep the boot camp for as long as you want. Rick's asking, you're buying or selling iron condors? We're selling. Pirka is asking, what time of the day are iron condors sent? We don't have a set schedule for that. It is a function of what the market gives us. All right, Steven's saying just join. Welcome, Steven. That's great. Cliff's asking, I thought you stacked your trades each week. Yes, we do, but we were able to exit some of our other trades quickly. Okay, and look, sometimes we don't get new trades off every single week. It is also a function of the market. Look, the market had been in a super tight range for the past 2 months. Right? We're not going to be fully automated here. We recognize some of the risk involved with trying to go short gamma when the market has been in a 25 handle range for 2 months. Okay, we don't want to go super risky. Okay, so we did recognize that there was a lot of upside risk in the market, so we didn't want to force our hand there. Michael's asking, didn't hear answer on the IRA. It's going to be a function of your IRA provider, but if you can sell spreads in your investment retirement account, then you can do it. Okay. Yeah, Ben's saying, why don't you have 3 or 4 iron condor trades on? Because volatility collapsed and we've been in such a tight range, we were able to exit some of our trades pretty early, and we were a little bit concerned about the upside risk, which so far has been justified. Bill's asking, can you repeat your email address? Sure. Let's just do this really quick. Blank document. Here we go. And I will be emailing you all with follow-up on this. But in case you want to get started shortly, I got to go eat lunch here soon, but I'll answer my emails after that. Steven@iwmail.com is my contact information in case you do want that case study. And once you join, I'm pretty sure the case study is also in there somewhere. Okay. What's the difference between your short strike and your long strike? 10 points. Arthur's asking 10x per trade or per year, per month. Okay, so if you're paying $99 per month, ideally we're looking to get you at least $1,000 per month. Okay, that's the 10x. That is not a guarantee. Past performance is not indicative of future performance and all of that. That's the financial disclaimer, but that's our goal, is to 10x the value of the membership cost. Kurt is asking, you're trying to get 80 cents on each leg of your trade. Yes, we talked about it in detail, 80 to 90 cents, so we're looking for about $1.70 to $1.80. The recording will be available for those of you that came in late. Mike is asking, this is a great question, are you moving the market when you group trades, when we trade? Not yet. When we start to see that, we're going to either double the price or just shut down membership completely. We have not seen that problem. We are aware of it. We do track, because sometimes we're like 50% of the volume on the S&P, but because, think about it, the SPX, right? If we were trading this, let's just say Priceline or CMG, right? Priceline and CMG, both very large stocks, and their option boards used to be liquid, but their option boards are dog crap now, okay? So those would not be a good opportunity, right? Now think about this. We're looking at the SPX, right? And we're looking at this market, and we want to be involved in this market. Now think about the market maker, right? If the market maker has to take the other side of the trade, well, they can use, and they have to hedge, they can use the S&P 500 futures, they can use the SPY, they can use all sorts of other things. So we can't move the market, okay? It's pretty impossible on the SPX for us to move the market. Now, if we aren't getting filled, we just simply send adjustment alerts and change the strikes and try and get in, okay? So liquidity is not an issue right now. All right, Jack's saying thank you for a great presentation. If there are any more questions from you all and you want to learn more, you can go to steven@iwmail.com. I think we have pretty well covered everything else. All right, William saying great presentation. In all caps, thank you so much. I look forward to seeing you all on the other side. You've got two decisions now. You can invest now and get started and start seeing results within a month of your training and working with us, or you can get off this training, go to bed later, wake up the next day, sit around, nothing has changed. You can repeat the same mistakes in whatever trading strategy you're using, and you can continue to be disappointed by your trading results. So you got to decide right now which choice is more exciting. I like you guys. This is fun. Hop into the chat room, ask a bunch of questions, start generating aggressive and sustainable wealth. Which one do you really want in life? Do you want to keep on being disappointed in your results day after day, month after month? Here's the thing. You're here. You showed up to this webinar looking for something to help you, and I've shown you how it's possible to get what you need, how we've gotten results for other people, and showing you how to get started. Okay? So get started today for just $99. You get the boot camp, and you get a month of Income Lab for free. After that first month, it is $99. The whole idea is to bootstrap your gains. Generally what happens is that if you have the right portfolio size, one good trade pays for a year